Hello and welcome to this special live show on Moneycontrol. It's just 2 more trading sessions to go before the election verdict, an event that the market has been eagerly looking forward to. Now the trend was very bullish at the start of this month, but some uncertainty seems to have crept in over the last few days. And one of our guests on the show earlier this week, Sushil Kedia, attributes this to selling by some of the skeptics and the weak hands. Now the big question is, will the skeptics be proved right on June 4th, or will the market be in for a pleasant surprise? Now, how do you position your portfolios and play your hand on June 4th and beyond? To tell us more about that, we have today in our studio veteran derivative and technical analyst Gautam Shah. Gautam, pleasure to have you with us over here.
Hi Santosh, thanks for having me.
Gautam, there seems to be some problem with the audio. I can't hear you.
Can you hear me now? Is it better? Can you hear me now?
Yes, I can hear you now. Sorry. Okay, so Gautam, you've been in the market for almost a couple of decades now. You've seen a lot of elections. I also believe that you've done a detailed analysis of how the markets has reacted post major election verdicts. So could you broadly tell us some of the findings of your analysis?
Yes, I think election times have always been interesting. I mean, if you look at the last 20 years and particularly the years of 2004 and 2009, I think you saw major moves at the market. I remember 2004 when BJP came to power, you had the index hitting lower circuit. And then 2009 when Congress came to power, you had the index hitting upper circuit. But please understand that what happens in that election period of about 15-20 days might not be the best indicator of what markets might do over the next 5 years. Because if you just take the example of 2004, after the lower circuit, there was a lot of pessimism in the market that, things are going to be difficult over the next 2 to 3 years. But the Indian markets actually went through its best rally in that 2004-2007 period. And again, if you go back to 2009, there was a lot of expectations that the next 5 years would be excellent. But actually 2010 to 2013, the markets did not really do anything special. So that's really the backdrop we are living with. 2014 was a special period because when the BJP government came back in power, you had a massive breakout at levels of 7,500. And those levels have never been seen in the last 10 years. So this bull market basically started in 2014, and you had some aberrations in between, mini bear markets in between, what happened in the COVID fall for about a couple of months. But what you're seeing today pretty much started off post the election results in 2014. Now, as we head into 4th of June, again, there's a lot of expectations. But I do believe, looking at the charts and my experience of the last 20 years, that markets are not going to be overly excited or overly disappointed. I think it's going to be more like a non-event. The event will pass, and thereafter you will have market participants going back to our own local fundamentals and the global factors that we look at on a day-to-day basis. So the idea is to not take on the event, don't take very speculative bets into the event. India VIX has already gone up a lot. But I do believe that if you stay in quality stocks, and this weakness that we've seen in the last 4 or 5 days looks like a buying opportunity, because I think as we get closer and closer to that 22,500 and 22,000 number, the risk reward to take investment positions is pretty high. So the key takeaway to your viewers is use this weakness and volatility to build a stronger investment portfolio, stay in top quality stocks, and I think it will be rewarding over the medium to long term.
Gautam, you track both derivatives and technical analysis. So tell us, how is the market looking at this point? Because the street is pretty much divided whether it's an overbought position at this point or whether it's an oversold. It doesn't look much oversold, but the big concern is whether the market is overbought at this point. So what is your reading of the charts?
See, in some sense, the market is still very overbought, no doubt about it, because everybody is overcommitted into the stock markets, thinking that this is a trend that is going to continue for years. I think it will, but it's not going to be an easy path, because even if you look at the last 4 months, the Nifty has actually given 0 returns. We started the year at 22,000. Today we are in the almost in the month of June, and we are still at 22,500. So actually there has just been 2.5% upside in the last 5 months, despite all the positive talk around the stock markets. So the Nifty hasn't really been the barometer of where the markets are, and the Nifty has been in this 22,000, 23,000 kind of a band, and I think this band will continue. There is a possibility that post 4th of June, the market could move out of this band, so that will be a big trigger whenever it happens. But I still feel that this is a market where you have to be in the right pockets, right themes, right sectors, and that's where the returns are. Because if you just follow the Nifty, there are no returns. But if you follow some certain sectors like metals or pharma or auto or FMCG, I think there are serious returns. So staying stock specific, ignoring the index, I think is the way forward. Market is slightly overbought, but I still feel that there is a lot of money on the sidelines, which will come in post the 4th of June, and that should probably propel the market higher if all is well.
Before we get into individual sectors, Gautam, I'd just like to know what are the key resistance and support levels that you are seeing for the Nifty in the short term?
Yeah, so I think 22,500 from a near-term perspective is a very important support, and we are right there right now. If the Nifty is able to hold on to this support level, then I think we can bounce back quickly and try and go back to the recent highs. Should 22,500 break on a closing basis, I think that will be a bit of a negative sign from a shorter term perspective. And then we are looking at a move back into the 21,850, 22,000 area, which is not my preferred view. So I think if today and on Monday, the market is able to hold on to 22,500, I think all will be well. And we can go back to 22,800 and 23,100, which I think are the major resistance levels for the next 5 to 7 days. And then depending on what happens on June 4th, we take it up from there.
Well, Gautam, many of the leaders have also said that the market is likely to make a new high very shortly. How soon do you see that happening?
Yes, I think the market was at lifetime highs just 5 days back. It's just that this correction of 600 points has got a lot of people concerned. But I do believe that if the election event goes off as a non-event, I think the market will be happy that, we at least have some sense of stability over the next 5 years. And therefore, I don't think then the market will take much time to go back to 23,100. But as I said earlier, everybody is overly committed. We are not cheap on valuations anymore. There are some global risks as well. US markets have seen a bit of a correction. US interest rates are unlikely to fall anytime soon. Keeping all of those factors in mind, don't have very high expectations from the Nifty. Stay in specific sectors and themes, and I think that you will be better off.
So how should you just mentioned overvaluations being one of the key risks for the market at this point in time, and the general view is that much of that overvaluation is being seen in the second line stocks. So how does an investor position his portfolio at this point in terms of a mix of large cap and second line stocks?
Yeah, what you're saying is absolutely right. I think a lot of mid caps and small caps are very richly valued at this point of time, and it's just momentum which is playing out and taking many of these stocks higher. So it might be a good idea to actually deploy large sums of capital in the large caps. I mean, you have many stocks across metals, pharma, FMCG, banks, for example, SBI and HDFC Bank, ICICI Bank look very good in the banking space. In the pharma space, we like Cipla, Dr. Reddy's and Sun Pharma. Metals, we have been a big fan of JSPL, JSW Steel, SAIL and NALCO. And in FMCG, we like ITC and HUL. Now, these are all, solid companies, great earnings, great visibility, have not done as well in the last 6 months. And I think your portfolio should be positioned into them. Maybe allocate 50 to 60% in these stocks, and the balance could be top quality mid caps and small caps. So stay with the top 100 mid caps, top 100 small cap. What happens is a lot of institutional money is actually flowing into those names. So even if there is market volatility, those pockets of the market will be protected.
So Gautam, let's just look at sectors one by one. Among the large cap sectors, IT for one, this is a sector that has not done much. The overall view seems to be very cautious. How are you approaching this particular sector?
Yeah, I think it's not seen any relative strength. In fact, it's been quite weak on an absolute basis and on a relative basis. in this market, you don't touch underperformance. I think that's something which I've learned in the last 3 years, that you stay with outperformers. That's where it is rewarding, like what has happened with real estate and capital goods and PSU. And IT sector obviously hasn't done very well. But still, if you are somebody who's looking at a 1.5 year kind of a view, I think TCS, HCL Tech and Tech Mahindra have potential. Don't expect trading returns, but from an investment perspective, these are good buys. So I would not say that IT looks good from a medium term perspective, but these 3 specific stocks definitely have good risk rewards because they are good fundamentally and the charts are much better for them.
So what could possibly change for better for the IT sector according to you, if you were one way to take a 6 to 12 month perspective?
See, there are a lot of dynamics at play, particularly global markets as well, what the Nasdaq does and how AI is going to shape up the world and shape up Indian companies, in the landscape of AI. I think these are factors to look at, and the fact that a lot of these IT companies are very richly valued at these prices. And that's probably the reason I think global investors are now moving towards value and not into growth. I think this has been a theme for the last couple of years, that value attracts a lot of capital, unlike what happened prior to, say, 2020. So given that, I just feel that IT as a space will not fall much and will not rise much. It's just going to be in a sort of a range. And in this market, opportunity cost is a huge cost. So you don't want to deploy capital in a sector or in an entity that doesn't do so well.
Right. You also mentioned FMCG there being one of your favorites. Now, again, this is a sector where there's been a lot of concerns over the weakness in consumption trends. Also, post the March quarter earnings, the commentary has not been all that inspiring. In fact, managements have been talking about recovery in rural demand, which seems to be taking some time to play out. So, given this backdrop, how would you approach FMCG stocks?
Please remember that markets are ahead of the times. Markets discount think well in advance. So keeping that in mind, FMCG have been an underperformer for the last 6 months now. And I think whatever you just highlighted is already in the price. So I'm not overly concerned. I think we've come to a point from where stocks like, ITC, HUL, Dabur, Marico, Colgate, could actually do well from here, because I think most of the negatives are in the price. And because the market is forward looking, and keeping the risk reward in mind, I think these are, strong companies with good visibility, not very richly valued. So keeping that in mind, I think a low beta portfolio, a low beta sector is a much better investment option than some of the other pockets of the market.
ITC is one of your favorites. So can you just tell us how the stock is looking on the charts? It's seen a very fast, swift run up. Most of the major events have played out there. Now, what are going to be the triggers for ITC going forward, and also the technical perspective on that?
See, if you look at the last 1.5 years, the stock moved up almost 2.5 times in value. From a level of 200, it moved to a level of 500. Everybody spoke about it. It was a great run. And then for the last 6 months, it's got into a healthy consolidation. So a 500 became a 400, and now it's stuck somewhere around 425, 430. I do see a lot of value because I think the downside is limited. 390 to 400 is a sort of a base. And once the stock starts trading above levels of 440, 445, that's when the technical trigger would come in, and it could then trigger a move back to levels of 500 and beyond. So again, purely going low beta and keeping the risk reward in mind and fundamentals in mind, I think the ITC is a good opportunity for somebody with a 12 to 18 month time frame. And along with ITC, which has been an underperformer, another stock that we have started to like after almost 3 years is HDFC Bank. I don't think there is much to lose there. Enough has been spoken about that stock. So I think both these big heavyweights, which have been underperformers, could possibly make a comeback post the 4th of June.
Let me just ask you a broader question there about the banks in general. Now, till last year, banks were supposed to have been one of the safest sector. Everything was looking in favor. But again, the mood seems to have changed slightly over the last few months. We are seeing a sharp divergence there. A lot of interest in state-owned banks. At the same time, private sector banks are underperforming. So how do you look at each of these two pockets now? A good run up in state-owned bank, does that make them expensive? And then you have the prolonged underperformance in private sector banks. So how should investors be looking at this sector?
See, the key theme has been PSU. You could be power, you could be infra, you could be banks. Anything that had the PSU tag to it has done well. And not to forget, many of these PSU banks were at low single-digit PE for almost a decade. So there was sort of a re-rating which happened in the last couple of years, and all of the PSU banks were a beneficiary to that. But now I think all of it is in the price. So there is a very large risk of holding on to smaller PSU banks at these prices. I would still just go with SBI, which is my favorite, and I feel SBI can do big things even from these levels. So if you want to be in PSU banks, just stay with SBI. On the other hand, I think the private banks should now make a comeback because they have been underperforming for a while. The recent price action has been encouraging. HDFC Bank is actually closer to the COVID high. So just tells you that for the last 3.5 years, the stock has done nothing. And along with HDFC, I think ICICI Bank has been the standout performer. I still dislike Kotak and IndusInd. I don't think one should commit there. But SBI, HDFC Bank and ICICI would be my pecking order in that space.
So what do you think from a fundamental perspective is likely to change for banks, because the credit growth appears to be now kind of moderating, what we read from some of the research reports. So what is going to be the big trigger? Is it going to be interest rate cuts?
Yeah, I think interest rate cuts would be the big trigger. I think earlier in the US we were anticipating it to happen in July. Now it's likely to happen in possibly August, September, or maybe even later. So I think the moment the market gets the signal that the interest rate cut is coming in the US and in India, I think banks will start to do well. And also we've seen this huge phase of underperformance because, stocks like these are not very, very expensive. Yes, they were expensive a couple of years back, but in the last couple of years, earnings have picked up. They have moved in line with what analysts and the market was in general expecting. So I think the waiting period in some sense is over, and that could also be a trigger, because if you have to allocate fresh money in today's market, you don't have too many pockets where you can confidently allocate. But with a company like HDFC Bank, you can't go wrong. I know it's underperformed for 3 years and we've stayed away, but now I feel the time has come to make some commitments there.
Gautam, are you also looking at the NBFC space? Any interesting names there?
No, we are not looking at it. NBFC is high beta. It's been an underperformer. It's just not participated with the market, and it's not a space we want to be in right now. I would rather be with the larger banks, where I think earnings and charts are much better placed than NBFCs, where we continuously see a lot of underperformance, and we've seen what Bajaj Finance has done in the recent past.
Well, Gautam, you spoke about the PSU tag and how any stock with the PSU tag has actually outperformed the market by a wide margin. Now, the next sector I would like to pick your thoughts on is the defense sector. Again, huge run up there. Now, for investors who have missed out on the rally, what would your advice to them be? And also to investors who are still sitting on huge profits in these stocks?
See, there is a case of FOMO in railway and PSU in defense at this point of time, because a lot of people who could not participate are not looking to participate at these prices, which I don't think is a good strategy, because I think all the positives are played out. The charts are not looking good. In technical terms, we are now seeing negative divergence in across stocks in railway and in defense and in PSU as a basket overall. So I'm not very comfortable buying into these stocks right now. I think they need a cool off. But if you have to look at India's story, and if you have to look at 3 to 5 years, defense is a story which is here to stay. So in case over the next 3 to 6 months, you get a nice dip of 10 to 15%, then look to allocate in defense. Right now, do nothing, or if you have been sitting on profits, take profits at these prices.
Well, moving over to the pharma sector, again a lot of divergence in trend there. Some of the stocks doing well and some others not so much. What is your view on this particular sector?
See, pharma has actually been the sunshine sector of the last couple of years. I mean, it's just consistently made a series of higher tops and higher bottoms. Look at what Sun Pharma has done, Zydus Life, Glenmark, Lupin, Aurobindo. Massive moves, massive trends in the last couple of years. I don't see this ending anytime soon. It's just that you have to be very careful in what you buy right now. Our focus remains at at Sun Pharma, Dr. Reddy's and Cipla. I think they could continue to deliver, and a stock like Divi's Lab, which is coming out of a long period of consolidation, could also do well. So I would stick to these four, and I would refrain from anything that has moved up in a vertical manner, like, an Aurobindo or a Zydus or a Glenmark has just seen a vertical move up. So these are not prices to make commitments.
And what about the diagnostics sector, Gautam? Are you tracking that space as well?
See, diagnostic, I think, has had its phases. There was a period in the past when it did very well, when it just lost its way, stocks corrected about 40-50%. Now it seems to be basing out and coming out of a range. So I would look at the Metropolis closely. I would look at Dr. Path Labs closely. Apollo Hospital has been a favorite for a while. So I would look at some of these top names. I think there is potential over the next 6 to 12 months, only because they're coming out of a long period of consolidation.
Capital goods, again a huge outperformer there, names like ABB, Siemens, Cummins India, which is also leading many people to feel that valuations have become really pricey, and this stocks may not offer much of an upside in the near term. But what do the charts say on that front?
Yeah, I think charts and fundamentals are pretty much hand in hand. I think the valuations are totally out of whack. Excel sheets have been factored in over the next 5 to 7 years, so all the positives are already in the price. I know it's on great momentum right now, and therefore it can continue to move higher in the near term. But I don't think these are levels where one should be committing into. And if somebody bought in early in the last couple of years, we've been a big fan of capital goods for the last 2 years and recommended on pretty much every single platform. But now we've come to a point where we are recommending profit booking in both capital goods and real estate. So that's the key message. Take profits here. I don't think it's going to keep running at the pace it has been for the last 6 months.
Gautam, any view on hospitality and aviation? Again, two sectors where the market is very bullish, but again, like with some of the other sectors like capital goods and defense, there are concerns of overvaluation, at least as far as hospitality goes, not so much maybe for aviation. So within the hospitality sector, how do you see the trend playing out?
See, I think after COVID hit us, there was this big theme of unlock, playing the unlock theme and unlock stocks. I've been a big fan because I've just realized that people are spending a lot more. I think from a savings economy, we are becoming an economy of people, who are spending a lot more. And because of that, I think hospitality, aviation, and this entire travel space is clearly booming. I think we spoke about Indigo sometime back, 6-8 months back. We continue to like it, and I think it will do wonders even from here. Indian Hotels has been our top pick for almost a couple of years now, and I do believe it will do bigger things from here. Yes, there is some argument that the valuations are pricey, but remember, India's positives, are on display, and I think some of these companies are absolutely top notch and they deserve rich valuations. So that's probably the reason I feel the bigger names in this hospitality aviation sector will continue to do well and will stay at high valuations for long periods of time. So don't just stay out of these names just because valuations are stretched. I think they will maintain this pace.
Well, Gautam, there's a growing perception that it has now become cheaper to holiday abroad than in India, and this is something that could work against some of the hospitality names in the longer run.
Yeah, that's a possibility. But then if you look at Interglobe Aviation, I think the performance it has had, whenever I take any flight of Indigo, it's always, pretty much packed. And given the market share and everything, I mean, it's a no-brainer. With Indian Hotels, you can't make, it has such huge entry barriers. I mean, you can't replicate in Indian hotels overnight, and the Taj brand deserves a valuation which is far greater than, say, second line, companies in the hotels business. So I think this is a theme which is here to stay, only because the consumption pattern in India has changed in the last couple of years.
Any risks to the consumption story as you see it because of high inflation? Because in the US, if you look at it, the inflation just doesn't seem to be coming off.
Yeah, that's true. Yeah, I think Santosh, that's a very key point, and that probably is one of the bigger risks that we are dealing with. But then against that, you have liquidity. With SIP of 20,000 crores coming into the system every single month, anything and everything on the fundamental side is being justified. And I think something similar happened in the 2003-2007 period, where we used to justify the fundamentals just because foreign money was pouring in on a monthly basis. Right now we have a similar scenario because that's being pitted against domestic money. So yes, inflation, consumption patterns, what happens to companies are all key risks. But I don't think it's going to impact markets immediately.
Okay, and one of the sector where sentiment has now turned positive, at least over the last couple of months, is metal space. So, what are the names that you are looking at in this sector, Gautam?
Well, metals continues to be a favorite, and I think the top names that we like are JSPL, JSW Steel, SAIL, and NALCO, and we see them doing bigger things. I think it's a much bigger theme which is at play. So, metals is probably our favorite sector for the next 6 to 12 months, and we would recommend your viewers to add on to investment positions on all dips.
Now, Gautam, within copper, aluminium, steel, fundamentally, which of these three segments look more promising? How would you look at that?
It's already played out, Santosh, because if you look at copper and zinc, whether it's Hindustan Copper or Hindustan Zinc, what a large move these stocks have seen in the last 6 months. Now, I think it's too late to take a trade based on what's happening globally to commodity prices. So I would rather stick to some of the other names, the steel names, where I'm a lot more comfortable. But copper, aluminum, and zinc, I'm not very sure whether you can make serious commitments at these prices.
So, you also mentioned about volatility suddenly increasing of late. That's mainly because traders are trying to hedge their positions. Do you expect wild swings next week also because of the fact that now we are seeing high frequency trading firms being much more active in the market and being a major driver of prices? So, how would you advise traders to guard against volatility in the coming week?
In the past, a 15% move or a 20% move was considered a wild swing. Now a 5% move is considered a wild swing. That's where we are right now. And India VIX has seen a very large rally from a level of 13. We are today at a level of 24. But historically, before the elections, India VIX usually tops out in the 24 to 27 zone. So keeping that in mind, I think post June 4th, the market is going to get quieter. I think that's my sense. And we will probably stay in this 1,000-point band. So I don't see very large wild swings. Maybe 2-3% is a possibility, but not larger than that, given the fact that the event is pretty much priced into and the expectations are already priced in.
Also, again, the same point on expectations, Gautam, like you mentioned in 2009, expectations were very high and then the market did not do anything for the next few years. This time also, if you look at it, expectations appear to be very high. That partly explains why the market is so overbought at this point in time. Do you see that as a possible risk to the market?
Unlikely. I think the key point from a domestic money and foreign money point of view is continuation of policy. So whenever you have a stable government at the top, and because India enjoys rich valuation compared to other markets and other countries in the world, it's very important that politics is stable so that India can deliver on the fundamental side and on the policy side and on the economic side. That's the bigger theme which I think a lot of institutional investors and large HNIs and celebrity investors would be looking at. So from that point of view, I think if the market believes on 4th of June that all is well and the next 5 years is sorted, we will go back to our own positives, and we do have a lot of own positives to play for and to discount over the next few years.
Well, before we let you go, Gautam, one sector on which I didn't pick your thoughts yet, auto, lots happening there also, both auto and auto ancillaries. How are you looking at this space?
See, auto has already done very well, so I don't think you can make any serious commitments right now. In that space, we have been liking Eicher Motors and Escorts. We did recommend it a couple of months back, and we like these two stocks because I think they are not retail favorites, but they could deliver serious returns. Other stocks have already done well, like a Tata Motors, Maruti, M&M. I don't think you can make commitments at these prices. Auto ancillary on the other side is a bigger theme because of EV, and I think EV is a theme of the decade. So keeping that in mind, the top quality, the top 3 or 4, 5 auto ancillary names can definitely be looked at from an investment perspective.
Well, we're just running out of time there. Gautam, thank you so much for joining us and sharing your valuable insights with us on this show.
Thank you so much.
Well.